Hey everyone, Sloan Artel here with my colleague, or I think she's probably going to be looking away from me until I acknowledge her as my boss, Sammy, um, the financial cat extraordinaire. And with our powers combined, we're here to answer probably the question that we get most frequently from folks in the Invest Vegan community, which is, I'm really interested in what y'all are doing, but I've been an index fund investor for all of my life. How can I incorporate the two approaches in a way that makes me feel not crazy? So we're going to go ahead and take on that question in this interview, and I'm going to give you a couple of mental models that you can use to think about how you're building your own active and passive portfolio in a way that's going to sort of meet your needs over the long term. Now, one of the most straightforward and frequent ways that you'll see people talking about how to do this is something called the core satellite portfolio. The idea is very simple. You take your portfolio and divide it into two pieces. Part of it is the core. Uh, Ostensibly, that's the biggest part of the portfolio. And the other part will be the satellite, right? So you could take your index fund portfolio, your target date fund, whatever it is that you feel most comfortable with, or that you're most accustomed to doing, and think of that as the core, and then think about the Invest Vegan portion of your portfolio as your satellite, right? This works best when you have one core and one satellite, right? Because what I hate to see is when this people have gone down this approach for multiple years and they've got something that feels like a passive core and something that and multiple things that sort of have the intellectual approach of being active satellites, but there's no overarching portfolio management discipline that is rebalancing between these things and keeping weights roughly equivalent, right? So the core satellite portfolio is a really thoughtful way to go if you feel confident that you're not going to wind up adding 3, 4, 5, 6, 7, 8, 9, 10 satellites down the road. um, it just can get a little bit messy if you feel like that's a way that you're going to go. Another option is the sort of thing that a lot of sophisticated high net worth investing firms do. They will sort of take your overall asset allocation, right? So in here, I've sort of created a hypothetical asset allocation for a client who's mostly invested in stocks, but has some space in their portfolio for some bonds and some real estate. What this investor would do is then go, okay, so in the stock portion of my portfolio, let's go ahead and make a whole bunch of determinations about whether I want to do active or passive for various components of the exposure. Now, this is the kind of thing you want to bring a spreadsheet for. You can divide the kind of the group stocks, bonds, and real estate into almost infinitesimally small boxes. And it is possible to spend a tremendous amount of time figuring out whether you think that you have an ability to identify managers that add value in the mid cap value space or something like that. It's very easy to go down a rabbit hole thinking this way. It is possible, and it is what happens in institutional portfolio design more often than not. But those folks who are doing that, probably best to think about it as their full-time job, right? The approach that I am partial to for folks who, are interested in index funds or whatnot, but not really sure how to go about it, is the core and complement approach, which is sort of active and passive management, both managed by the same person. In this case, me. And obviously I drew this wonderful piece of art here. But basically what the core and complement portfolio is our, Veda integral portfolio, which is our most diversified approach designed for really long-term investors who, want the benefit of the active work we're doing, but don't want their performance to deviate too meaningfully from, kind of the long-term stock market indices, right? And what I think is particularly compelling about going this way rather than thinking about it all as like, okay, 80% this way, 20% the is that I'm actually able to say, okay, well, here is an area that I think is appealing, that I don't have a particular strength in. Let me add that to the mix, right? Now, if you're able to work with a manager that's able to do that and interested in doing that, I think it's a pretty strong approach, because the type of partnership that you're able to build, when the manager is looking after not just the things that they think are the most compelling, kind of performance opportunities, but also the broad exposure that's likely to kind of generate the highest risk-adjusted returns over time. I think that can be a pretty significant formula for success, and so that's obviously why I do it. But you can design your own complement on your own. You can sort of take, let's say you were to decide that Invest Vegan was a core position, and you didn't want me to design the complement portion. What you could do is sort of go and say, okay, well, let's look at the sectors here. Let's look at the geographic exposures, and let's try and add some stuff that has exposure that Sloan hasn't generated in her flagship strategy. So that's something that you could do. I think it probably would save you some time if you wanted to go that route, to just cheat off of my homework. I'd be more than happy to show you the way that I would put that together for you. But this is three, I think, pretty solid approaches, right? The core satellite approach, I think, will be what most people wind up going with who don't want to, have the whole, core and complement thing that I manage for them. The kind of nested decision-making tree, I guess, sort of gives you a sense of how the big gals do it. And geez, whatever Sammy is staring at sure is very cute. Anyway, thank you so much for joining us, and look forward to sharing more financial feline insights before too long. Bye-bye.